On December 4, 2025, Philips' shares took a dramatic hit, sending shockwaves through the financial world and catching even seasoned investors off guard. The stock price plunged over 6% in a single trading day, a staggering loss for a company of Philips' size and reputation. This sharp decline marked the largest single-day drop since February, instantly making Philips the worst performer on Amsterdam's AEX index, and drawing the attention of analysts and media alike. Investors were left stunned. Up until that point, Philips had been performing reasonably well, with steady growth and no major negative headlines. The sudden sell-off wiped out billions in market value in just hours, leaving shareholders anxious, markets rattled, and many wondering what could have caused such a dramatic reversal of fortune. So, what triggered this unexpected collapse? Surprisingly, it wasn't a product recall, a lawsuit, or a major scandal. Instead, it all started with a single analyst report from Citi. The report raised serious red flags about Philips' future prospects, highlighting potential risks and uncertainties that had previously gone unnoticed by the broader market. Its influence was immediate and powerful. Spooked by the new, more pessimistic outlook, investors rushed to sell their shares, triggering a cascade of sell orders and sending the price tumbling even further. This event served as a stark reminder of just how quickly information, especially from influential sources, can reshape a company's fortunes and alter the mood of the entire market. In the world of finance, perception is everything. On this day, perception changed in an instant, and with it, the fate of Philips. At least for now. The big question now is, what exactly did the Citi analysts see in Philips' future that everyone else missed? The answer could shape the company's path for months to come.
To understand why Philips stock took such a dramatic plunge, we first need to explore a crucial tool in the world of finance, the analyst note. So, what exactly is an analyst note, and why does it hold so much power over the fate of companies like Philips? Think of financial analysts as detectives for investors. They work at major institutions, like Citi, Morgan Stanley, or Goldman Sachs, digging deep into company data, industry trends, and even global events that might affect a business. Their job is to piece together all this information, analyze it, and then publish their findings in the form of analyst notes, detailed reports that can shape the opinions of investors worldwide. These notes don't just summarize facts. They often include recommendations, like whether to buy, hold, or sell a stock, based on the analyst's expert judgment. For big investors and fund managers, analyst notes are essential. With thousands of companies in the market, they simply don't have the time or resources to research each one in depth. That's why, when a respected analyst issues a negative report, it can trigger a wave of panic selling, sometimes within minutes. This is exactly what happened with Philips. A single analyst note set off a chain reaction in the market. The note from Citi questioned Philips' future growth prospects. Because Citi is such a major player, investors paid close attention, and many acted fast. The result? Investors rushed to dump their shares, causing Philips' stock price to tumble sharply in a matter of hours. Analyst notes are incredibly powerful. With just a few words, they can move billions of dollars and reshape a company's future almost instantly. In Philips' case, a few paragraphs from a trusted source changed the company's outlook overnight, leaving executives and investors scrambling to respond. The lesson here? In the stock market, expert opinion, especially from influential analysts, can be just as impactful as breaking news or official company announcements. That's why analyst notes matter so much. They're not just reports. They're market-moving forces that can change the fate of companies in a single day.
The Citi analyst's note followed comments from Philips' CEO at a major healthcare conference. The analyst interpreted the CEO's remarks as signaling slower sales growth than the market expected. Growth is crucial. Investors want to see rising sales and profits. The Citi note suggested Philips' growth in 2026 would lag behind the consensus forecast of 4.5%. Instead, the company aimed for a gradual climb from 2% to mid-single digits by 2026. This slower trajectory alarmed investors. Share prices reflect future expectations. When those expectations are lowered, prices fall. The Citi note shifted the narrative from optimism to caution. Investors, fearing weaker growth, rushed to sell. The result? a sharp, sudden drop in Philips's value. Sometimes it's not the facts, but the interpretation that moves markets.
At the center of the Citi report was a critical issue for Philips: its organic sales growth, or more accurately, the lack of it. This metric is often seen as the true measure of a company's ability to expand its business from within, without relying on acquisitions or external boosts. For Philips, this number was underwhelming, and it quickly became the focal point for analysts and investors alike. Organic growth means increasing sales through your own innovation, marketing, and operational improvements, not by simply buying up other companies. It's about building real momentum from the inside out, and it's a sign of a company's underlying health and competitive strength. Investors pay close attention to organic growth because it shows whether a business can truly thrive on its own. Strong organic growth reassures them that the company's products and strategies are resonating in the market, and that future profits are likely to follow. Philips set a goal to accelerate from a sluggish 2% growth rate to mid-single digits by 2026. But even with this target, the journey looked long and uncertain. The company's own projections suggested that any real acceleration would take time, and there were no guarantees. The market, however, had been hoping for a much faster turnaround. Many investors were looking for signs that Philips could quickly regain its former momentum and deliver stronger results in the near term. In the world of stocks, timing is everything. When growth is delayed, a company's shares can quickly lose their appeal. Investors don't want to wait years for improvement. They want to see progress now. The Citi report didn't just highlight slow growth, it cast real doubt on Philips' entire recovery plan. It raised tough questions about whether the company could deliver on its promises and what that meant for its long-term prospects. Investors crave certainty and momentum. They want to back companies that are moving forward with confidence and speed, not those stuck in neutral or moving too slowly. When a company signals that progress will be slow, investor confidence can quickly fade. Doubts start to creep in, and the risk of losing support grows. That's why the Citi note landed with such force. It directly challenged the narrative of a quick Philips comeback and forced everyone to reconsider their expectations. For Philips, the real risk wasn't just about slower growth. It was about something even more valuable: the trust and confidence of its investors, which can be much harder to rebuild once it's lost.
The Citi note also flagged tariffs as a growing threat to Philips.
For a global company, tariffs mean higher costs. Either you absorb them and hurt profits, or pass them to customers and risk losing sales.
Philips warned that tariff headwinds would nearly double in 2026, squeezing margins even further.
Even as Philips tries to grow, rising tariffs threaten to eat into earnings.
This adds another layer of difficulty to Philips' turnaround. The company faces not just slower growth, but also mounting external pressures.
Investors saw a double whammy: sluggish sales and rising costs.
The market quickly recalibrated its expectations. For Philips, the road ahead suddenly looked much steeper. Tariffs turned a tough situation into a real challenge for future profitability. After the share price crash, Philips moved fast to calm the storm.
The company clarified that no new official financial targets had been released. Recent CEO comments were just part of a broader discussion. Philips urged investors to wait for its full strategic update, scheduled for February 10, 2026. Philips reaffirmed its goal of accelerating growth, but stressed the process would be gradual, not explosive.
The statement aimed to steady nerves and push back against the Citi note's negative spin. Philips wanted to regain control of the narrative and stop the panic selling. While the response didn't erase the losses, it was a crucial step in restoring confidence. The company signaled it was listening and ready to address concerns head-on. The sell-off was especially jarring because Philips had just posted strong third-quarter results.
In November, the company beat profit expectations and reported 3% sales growth, a sign its turnaround was gaining traction. Philips had been recovering from past setbacks, including a major product recall. The company was also innovating, launching new AI-powered products and taking steps to offset tariffs.
Investors were starting to believe in the comeback story.
But the Citi note shifted focus from recent wins to future risks. Suddenly, optimism gave way to anxiety about slower growth and rising costs.
The clash between positive results and negative outlook created confusion.
The market's mood turned on a dime, showing just how fragile confidence can be. For Philips, the challenge was to keep the recovery narrative alive amid new doubts.
The discussion also shed light on Philips' outlook for 2026.
Hospitals are Philips's main customers, so their spending plans matter. Philips expects US demand to stay strong, which is good news for its healthcare business.
In Europe and other regions, conditions look steady but unspectacular. China, however, is a concern. Philips described the market as muted, signaling weak demand.
This mixed global picture explains why overall growth may be gradual. Strong US sales could be offset by weakness in China.
Philips must capitalize on its strengths while navigating challenges abroad.
The company faces a complex landscape, opportunities in some markets, headwinds in others.
For investors, this means the path to rapid growth is far from certain. Philips' future will depend on how well it adapts to these shifting dynamics.
Philips' share price plunge was a wake-up call about the power of expectations. Investors had hoped for a fast recovery, but the Citi note forced a reality check. The company's response was measured, reaffirming its goals, but managing expectations.
All eyes are now on February 10, 2026, when Philips will unveil its detailed strategy and targets.
This will be a pivotal moment. Can Philips convince investors its plan is credible and achievable?
The company must rebuild trust and show it can deliver steady growth, even if it's slower than hoped.
In the stock market, perception shapes reality. Philips' challenge is to perform and communicate better than ever. The coming months will test its leadership and its story. For Philips, the future is still open, but the stakes have never been higher.